Okay, so today we're going to do investment in securities, and we're going to use Pender Corporation as to illustrate the concept of equity method of accounting. So Pender, this question had Pender buying 30% of Salt Springs for $234,000. That's on January 1st, year 6. And Salt Spring paid dividends of $100,000 and reported a profit of $290,000 and discontinued operations loss net of tax of $30,000. Pender's profit for year 6 consisted of $900,000 in sales, expenses of $600,000, and investment income from Salt Spring. Okay, so when we're dealing with investment accounting, we need to understand the methodology in which we account for the investment. And the method of which we account for investment is going to depend upon the level of influence you have of another company. So what I have in front is I have the percentage of ownership from 0 to 100% as two different extremes. So if you have ownerships of less than 20%, your level of influence is considered to be little or none. And when you have ownership of greater than 50%, it assumes that you have a control relation. You have a relationship, or your level of influence is control. You control the organization, the subsidiary. And that's when you have a subsidiary and parent relationship. Now, when you get between 20 and less than 50, you are considered to have a significant influence as a level of influence. And that means that you don't have control, but yet you do have the ability to influence their operating, their financing, and investing activity. And that's essentially what happens when you own 20 to 50. Now, when you own 50%, you're considered a joint venture or a joint arrangement. Okay? And of course, we're going to take a look at what type of investment and, of course, the accounting method associated with it. Now, let me start with control. If you own 100%, then you have control exist. In IFRS, there is a change in the way we define control, and it is covered under IFRS 10. That's the new section, and that's effective for 2013. And it basically says control exists if and only if the investor has power over the investee, it has exposure or rights to variable return from its involvement with the investee, and so it has to have all three of these, and it has the ability to use the power over the investee to affect the amount of those returns. So that's the new definition of control. So in essence, a company could hold less than 50% and still have control. In other words, if they own less than the majority voting rights, as long as it has practical ability to direct unilaterally the activity that significantly affects its return. So in other words, I could own less than 50%, but yet I may have other activities that will allow me to have that control, that influence, that exposure, that power over the investee. So that's the new definition, IFRS 10. And that means that we have a subsidiary, and that accounting method is consolidation. So that's the only choice. Now, with respect to joint venture, there is actually, again, a new standard is joint. This is IFRS 11. And that's a new standard, again, effective January 1st, 2013. And the way it works is you've got a scenario where Perhaps you don't have control and you have a 50-50 ownership with another party. That means you have joint control. And we need to define what type of joint arrangements you have. So if the answer is if you don't have joint control 50-50, then you have to ask, do you have significant influence? If the answer is I don't have significant influence, then we are covered under IFRS 9, which are all of the fair value through P&L, the investment method accounting for investments. This is your less than 20% ownership. If you have more than 20 but less than 50, then you've got this concept where we have significant influence and we need to account for the investment under IAS 28, which is the accounting for significant influence, and the disclosure is under IFRS 12. Now, if you answer that you do have joint control, then you do have two different types of joint control arrangements. You either have a joint operation, which is covered under IFRS, which is covered under IFRS 11, sorry. And if you don't have a joint operation, you may have a joint venture. Now, in either cases, if you have a joint venture, then you account for the investment under the equity method. So this is the equity method. If you have a joint operation, then you need to account for your proportionate share of the assets, liabilities, revenue, and expenses. And that's what the joint operation is. And we're going to talk more about that as we go through other materials. Now, obviously, if you have control, then the answer is yes, you must use consolidation. So let's come back to this chart. You'll see that we've now said if you have a 50-50 ownership, you either have a joint venture or joint arrangement. And of course, the type of investment is a joint venture or joint arrangement. And the only option you have is equity method, or you pick up your share of assets, liabilities, revenues, and expenses. If you have a 20% ownership, 20 to 50%, you considered significant influence, and we use the equity method of accounting. And of course, if you have less than 20%, you consider a passive investor, and the only option we have is either cost or fair value. Now, this question Pender focuses on significant influence. So let's take a look at the accounting for that before we go right into the question. So Pender, the equity method of accounting requires us to record our proportionate share of income of the investee. And we also have to pick up our share of the dividends received. And how do we do that? Well, this is the T account for the investment of, let's say this is Pender, and this is the balance sheet. So this is the investment in shares of the company, and this is essentially the balance sheet. So we're going to start with the original cost. This is what we paid for the shares. And we're going to actually increase the investment based on our proportionate share of investees' income earned. Obviously, if it's a loss, it would be on this side of the T account, a credit side. We also pick up our share of our dividends received. So this one, the entry for this one is debit cash, credit investment. This one, it's going to be debit investment, which is this one, debit investment in ABC shares, which is on the balance sheet. And we're going to credit investment income or equity in equity income. And this is on the income statement. Okay? Now, you'll notice there's a couple of other adjustments here. Now, obviously, if you dispose of the shares, you would use the average, right? Average book value of the shares. So, for example, if I purchased 200 shares originally and dispose of only 10 shares, then I need to determine the book value of the investment account. I'm going to divide that by the number of shares to calculate the value of the 10 shares. Now, this acquisition differential, this is what it's called, acquisition differential. Amortization, what is that? Well, let's take a look at this one in greater detail. So acquisition differential is the difference between what the investor paid less the investor's proportion share of the book value of the net identifiable assets of the investee. So what you're basically doing is you're determining that this is what you paid less what is the actual book value of the identifiable assets of the investee. That acquisition differential is then allocated to the specific assets of the investee. And that specific asset, what we're trying to do is we're trying to allocate the fair value difference. Fair value differences. And then, of course, the difference goes to goodwill. And that's essentially what we need to do. Now, the depreciation of the investee must be adjusted to reflect the additional depreciation of the acquisition differential. So that's what this is. So we need to calculate the acquisition differential. So perhaps the investee, using historical cost method, would have recorded the equipment or building at original cost, less whatever amortization they've taken. Now, what happens is when we buy the business, when we buy that 20% or 30% ownership, we're going to actually pay more for the book value because obviously the equipment or the building may have fair value greater than book value. When we calculate the acquisition differential, we're going to take the fair value difference, which is fair value less book value, of, let's say, the equipment. And we're going to amortize that further and further reduce the investee's, our proportionate share of the investee's income when we pick up our share of that income. And goodwill is no longer amortized, but we test it for essential impairment testing, which we're going to take a look at that a bit later. But impairment testing is what we need to do for goodwill because goodwill is no longer amortized. So we need to know a little bit of this technical knowledge to be able to understand how we solve Pender. So that's what this is. Acquisition differential amortization means that if the equipment's fair value was greater than book value, when we purchase a significant influence share or position of that investment, then we're going to amortize the acquisition differential based on the remaining useful life, and we're going to offset it against the investee's income. Okay, and of course, other adjustments are related to intercompany sales, and we're going to talk a little bit about that later as well. Okay, so let's take a look at Pender. Okay. So in this question, Pender, we paid investment. So the first requirement requires us to prepare the journal entries necessary to account for Pender's investment of Salt Springs. So this is on Pender's books. So the first journal entry under the equity method First, I'm going to debit investment. I'm going to credit cash. I'm assuming I paid cash for it. Now, Pender reported income of $290,000. So we're going to debit investment. That's $290,000 times 30%. It's going to be $87,000. And we're going to credit investment income. This is the equity method. We're going to pick up our share of Pender's, or Salt Springs. Pender will pick up our share of Salt Springs income at 30%. Now, it says here that Salt Spring also reported discontinued operation. And our standard requires us to keep the nature of the source of income. When Pender reports the sources, our proportionate share of Salt Springs income, it requires us to report our proportionate share of that source of income, and it also requires us to report and present that particular source of income on the books of Pender. So in this case, we would debit investment lost, discontinued operation, and this will be reported as part of discontinued operations section of Pender's income statement. So that's really important because it follows, the nature of the source of income follows follows the source. So this is 30,000 times 30% is $9,000. We're going to debit the loss and we're going to credit investment. Okay, in S, right? I'll just short form it. Okay? So that's the key, is we pick up our share of income. And we're also going to pick up our share of the loss. But again, we're going to keep the nature of the loss. So this loss of $9,000 is going to be reported as discontinued operation on Pender's books. And so that's the first part. So let's label that A and B. And C, we're going to pick up our share of the dividends. So dividends received. So we're going to debit cash, 30% of $100,000. That was the dividends declared. And we're going to credit investment. And that's our share of the dividends. Okay? Now, Part B requires us, or Part 2 requires us to determine the investment. What's the value of the investment? Now, in this case, in this question, there weren't any acquisition differential. So remember we talked about these acquisition differential. It's going to impact the way we're going to adjust the income. So we talked about that. So we don't have any acquisition differential, but what we're about to do is we're about to actually take a look at what the investment in Salt Spring Company would look like on the balance sheet. So let's take a look at that. So let's go to the next page. So we're going to have the investment. So I'll just use a T account, investment, an S company, that's Salt Spring Company. We're going to start with original cost, what we paid, which is January 1st, year 6. We're going to pick up our share of income for year 6, and that would be $78,000. And that it would be the difference, that 78 is made up of 87 minus 9. And then we're going to look at the dividends received. And that would be 30,000 on the credit side, right? Leaving us a T account balance of 282. Then it asked us to prepare the income statement of Pender. So this is part C. So Pender Corporation, statement of operations. For the year ended December 31st, year 6. Sales, this will be only Pender's. And that would be, and we were given that, it was 900,000. And you're going to have investment income. And that would be 87,000. So this would be the regular. So that would be the regular income, right? This was the regular income. And this is the discontinued. So that would be this one. Okay? And that gives us a total of 987. We're going to subtract operating expenses, 600,000, leaving us income from continuing operations, and that would be 387. Now, we're going to subtract investment lost from discontinued operations of 9,000 to give us our profit. And that discontinued loss is this number here. There is a requirement to segregate that discontinued loss of 9,000 separately from the 87,000. And that's the equity method of accounting. Now, the next part of the question says, what if we use the cost method? So now we're asked to say, what would happen on Pender's books if we use the cost method? And cost method is actually says that we only record our share of dividends. We do not record or reflect our share of investees' income, Salt Springs income. So in that case, we're going to first record, we're going to debit the investment and credit cash, so an S company. And we're going to we're going to record 234. And we're going to only reflect the dividends. But this time, we're going to record that as dividend income on the income statement. So we do not update the investment at all. Now, that means that the investment T account will have the original cost, and there'll be no other changes. That's what's going to happen, is there's not going to be any activity. The only way we're going to perhaps impact this if there was an impairment. So that's the only way we adjust. Adjustment to investment, okay, is only if there is an impairment of investment. That's the only adjustment. That's the only time we would adjust for that. Now, in this case, for part 3, it asks us to provide the income statement of Pender. So you got Pender Corporation, statement of operation, the same as the other statement, right? And it's for the year ended December 31st, year 6. We're going to have sales, Pender only. Dividend income, 30. Less operating expenses, and that's the profit. So see the difference in the profit? You'll see that the profit amount under the equity method is 378, right? This is the equity method. And this is the cost method. And you can see that given the fact that the income was greater than the dividends is the reason why the equity method would show a much higher income. So the question says, which reporting method would Pender want to use if it's biased to report the highest possible return on investment? So Pender would probably want to use the equity method because it's a much higher income, and therefore it will show a higher return on investment. And it makes sense because the equity method takes into account the full increase in the value of the investee. So the full increase in the value of the investee would be the changes in the investee in Salt Springs shareholders' equity. That would be an increase because of income and a decrease because of the cost of the dividends. And you'll see that the return, and if we want to complete this question, we see that the return on investment under the cost method, the return on investment, the ROI, is 30 divided by the investment. Under the equity method, the ROI is 87 less that 9,000, which gives us 78,000, divided by 234. And this is more reflective. And given the fact that you've got significant influence, this to me is much more better representation of Pender's investment return on investment. Okay, thank you.